Good afternoon. I'm Mark Altschul and am the president of CFA Society Atlanta. A couple of programming notes. First is an online series. Is this economic tango being led by the virus? That's scheduled to take place on October 14th from 12 to 1 p.m. An online series, Data Science and Asset Management, on October 19th from 12:30 to 2:30 p.m. And then another presentation in our online series, Anatomy of a Private Equity Secondaries Deal, on October 24th from 12 to 1 p.m. Hello and welcome to our online series, An Economic Outlook from Federal Reserve Bank of Atlanta. We're joined today by Brent Meyer, who is an assistant vice president and economist in the research department at the Federal Reserve Bank of Atlanta. He leads and sets the strategic direction for the Economic Survey Research Center, provides leadership for the monetary policy advising process, and serves as a member of the research division's leadership team. Please submit your questions via the Q&A feature within the Zoom controls at the bottom of your screen. Brent?
Thank you, Mark. I appreciate the introduction. Good afternoon, everyone. I'm going to share my screen here. And I hope you can see that. If you can't, I guess put it in the chat. We're being recorded, so I need to start with this disclaimer. These are my views and mine alone. They do not necessarily reflect the Federal Reserve Bank of Atlanta or the Federal Reserve System's views. It'd be nice if they did, but nonetheless. So let's get started. What I'd like to do today is chat with you for about 40-45 minutes about the outlook, or at least how I'm viewing the outlook. Some salient features around the policy discussions that I think are playing out in the news, and then open it up to your questions. So without further ado, let's begin. Oop. So I wanted to start here with the notion of path dependence. And path dependence here is going to, I think, play a role in how monetary policy is likely to unfold from here. And all right, these cheesy graphics I pulled off of Google images are the QWERTY keyboard versus Dvorak and the VHS versus Betamax. What's the point here? Well, the point is that gravity or the amount of individuals that flock to one or the two of these options tended to be something that happened in a natural way, but it happened in a way that left us in a less efficient place. So the Dvorak keyboard is something like 70% more efficient than the QWERTY. The reason for the QWERTY was with actual typewriters and their keys getting stuck. So you know, we ended up adopting the QWERTY, even though it's less efficient. And as we moved to computers, the key sticking was much less of an issue, but we stayed on path. With VHS versus Betamax, I don't know if there's many people in the audience that actually had the pleasure of owning a Betamax, but it was a superior product in almost every way. The visual quality was better. The audio quality was better. It actually, a standard tape could record 3 hours worth of programming instead of about 90 minutes. It was a better product. Yet, because adoption of VHS was much broader, we ended up on this path moving away from Betamax, moving away from what might be the most efficient situation. And I just want you to keep that in the back of your minds as we go through the presentation today, because I think there's some aspects of the outlook that have us moving down this path in a way that really needs consideration. Okay, I'm going to move to a couple of slides with text. I'll have lots of fun pictures after this. So if we can get through these texts, I think we should be okay. This is just some setup text from the September FOMC policy statement. The big note here is right here. With inflation having run persistently below our longer run goal, and this is over a time period prior to the onset of the pandemic, The committee will aim to achieve inflation moderately above 2% for a time, so that inflation averages 2% over time, and longer run inflation expectations remain well anchored. So in the setup to the policy statement and the outcome from the September FOMC meeting, the notion that we have to catch up from a soft inflation period prior to the pandemic is still front and center in the messaging. The other point here is that when evaluating the outlook, there are really two sides. The Federal Reserve has two sides of a mandate. It has the full employment mandate and its price stability mandate, which I just highlighted. The notion of what the Federal Reserve is doing right now, early on in the pandemic, it dropped the Fed funds rate basically to its effective zero lower bound. And then it started engaging quite significantly in large-scale asset purchases, or what some people refer to as quantitative easing. And the committee has started to signal that we may be at a point where these asset purchases are no longer useful and appropriate to maintain. So they put in this clause in the September FOMC meeting that that we were going to continue to buy $80 billion worth of Treasury securities and $40 billion worth of agency mortgage-backed securities until substantial further progress has been made towards maximum employment price stability goals. I'm going to argue that we've met our price stability goals in this presentation, and I'm going to give suggestive evidence that if we already haven't made substantial further progress towards maximum employment, we're pretty close. Okay. So what I'd like to do is start by reevaluating the current situation in the COVID pandemic, COVID recession with fresh eyes. So on the left-hand side is the quarterly annualized percent change in gross domestic product, overall real GDP. It's been adjusted by inflation. This is basically the value, the growth rate and the value of all goods and services newly produced in the U.S. economy. And what we can see is that in the second quarter of 2020, we witnessed the sharpest decline in overall GDP that we really have on record, or at least post World War II on record. And then following up, the sharpest rebound in growth, 33.8% at an annualized rate in quarter three. You can attribute a lot of this to mandated lockdowns, engaging in a lot of social distancing, and the overall halting of the economy, basically as the pandemic really hit the U.S. shores starting in early March. As we've moved forward in the recovery, growth has still been very, very strong. So 4.5, 6.3, 6.7% growth. Those are meaningful growth quarters, much higher than what we would typically get during a normal expansion. And in fact, the sort of general profile of the level of GDP growth, this is on the right-hand side of your screen. We've already fully recovered back to where the level of GDP was in the fourth quarter of 2019, so before the pandemic really hit. That's a pretty quick recovery. How quick? Well, let's compare it to a slow recovery. So this blue line here in this picture is the COVID recession. We're going to say that the peak here was the fourth quarter of 2019, and let's compare that to the 2007 through 2009 financial crisis. The peak there was the fourth quarter of 2007. It took a little over a year, I guess, for us to regain our previous level of real GDP in the current recession, and it took coming out of the financial crisis. It was much more protracted. It took about 3 years or so to regain that previous level. That's saying nothing to regaining its previous trend, but that's a slightly different topic. Yet, even as we've regained the previous level of GDP, employment hasn't fully recovered to its pre-pandemic levels. In fact, as of August of 2021, so a couple months ago, excuse me, the employment shortfall relative to February of 2021 is still about 5.3 million workers. And that is something I want to talk about. And I want to dig into a bit later in this chat, is it appropriate to think about the pre-COVID benchmark in non-farm payrolls and employment being trying to get back there in order to say we've made substantial progress towards our mandate? Or maybe are there impediments to firms being able to bring back these sets of workers and get back to the employment levels we had prior to the pandemic? So I want to dig into this a little bit deeper, because I think there's some really interesting pieces that we can uncover, and it can shed light on how we're viewing economic progress. And lastly, I think this is one of my areas of focus. I've studied sort of inflation and inflation dynamics and measurement since I started at the Federal Reserve in 2006. And one thing we've seen here is I'm plotting the core CPI. So this is the measure of consumer prices that excludes food and energy. And that has risen sharply over the last year, up, right around 4%. And I know this is a hot topic. I know a lot of people are concerned about this, and I want to dig into different aspects of the overall inflation dynamics and come to some sort of notion of whether or not this is what some have referred to as transitory, or maybe this is more episodic and something that might last a bit longer than others are anticipating. Okay, I'm showing you some squiggly lines. These squiggly lines are from some of the surveys that we run. This is from the Survey of Business Uncertainty that we run out of the Atlanta Fed. It's a national survey of businesses. It tries to be fairly representative of the overall U.S. economy. And we partner with Nick Bloom of Stanford and Steve Davis of the University of Chicago in producing this survey. And what I want to highlight here is that, so we had a couple of key facts about growth, the strong decline in GDP and sharp recovery, the persistent sort of drag or shortfall in employment, and some sharp overall inflation as sort of aggregate facts that we're dealing with. But perhaps more importantly, and different than most recessions, in my opinion, the pandemic has led to a dramatic increase in dispersion. And basically the way not only that individuals are viewing economic conditions, but also how businesses and households are experiencing the economy. And we've seen this dramatic dispersion. And on the left-hand side, this is showing us dispersion or the distribution of realized sales revenue growth rates over the previous year. So this is a trailing look at growth. And you can see once, in about March, April of 2020, we saw a dramatic widening in outcomes. And there was obviously a large sector or large sectors of the economy that were negatively impacted by the pandemic. But as time moved on, that tightened up a bit, and we saw more dispersion to the upside. So we're seeing a lot of very, very strong growth in a share of the of the business community, and in that strong growth, there's still this dramatic dispersion, and we see this in their expectations as well. So this is the subjective distribution of future sales growth rates. We take this and calculate this from some questions, our core questionnaire that asks about sales growth over the year ahead and asks for a variety of scenarios from lowest to highest growth that a firm might expect, and ask them to assign the sort of probability or likelihood of obtaining that growth rate. And you can see here the same sort of pattern that we see in realized growth rates. This dramatic tail risk dropping out at the beginning of the pandemic, widening in the distribution. This widening in the distribution, or this dispersion across the economy, you can also see in some of our other survey data, and you can see this in national aggregate data. This is from our business inflation expectation survey. And on the right-hand side, this is just to show you that smaller firms disproportionately, at least on the initial impact of COVID, were harder hit than larger firms. And we've also seen a dramatic shift in employment toward industries that can sustain higher levels of working from home. So this picture here looks at employment growth across different industries during COVID and prior to COVID. And these are ranked by their ability to work from home, with the least suitable remote work being at the top and most suitable at the bottom. We can also see dispersion not only across the business community, but we can actually see it within cities, not only within cities, but across cities as well. And this, we think, is related to the propensity for individuals to be able to work from home, and how that has led lots of households to reevaluate their current living conditions. So this picture is showing us that rents and home values fell in central business districts and in higher density areas of cities, and increased dramatically in the lower density areas. So you can think about this as workers forming an expectation that they can work from home more often after the pandemic's over, and wanting to, or perhaps be fully remote, and wanting to find a place with a larger house and a bigger yard, or further away from people. So again, dispersion across both within and across cities. And then starting to dig into that first picture, this is looking at dispersion across skills. So one of the things that we can take away from the COVID-19 recession and pandemic is that the lowest skill workers, so these are individuals that are typically in service jobs, primarily, they're in face-to-face jobs and leisure and hospitality, and restaurants. These individuals tend to be the hardest hit and have recovered the least, at least so far through August of 2021. In fact, high skill workers, in part due to their ability to sustain work remotely, have been impacted less, and their employment is almost fully back to where it was in February of 2020. It also tends to be the case, and I wanted to dig into this here in a little bit further, is that if we look across these skill groupings, high skill, middle skill, low skill, and then look by gender, you can actually see that one of the hardest hit groupings, it has been female low and middle skill workers. And there's a very clear reasoning for this that I'm going to point out a little bit later. But again, dispersion not only across skill groups, but across male versus female. And you can also see dispersion across different demographic groups. Again, the way that the pandemic has played out has led to a dramatic widening in the way that various individuals and businesses are experiencing the pandemic, or are experiencing the economy. Okay, and then here's another rather unusual aspect of what's happened recently. And this is what I'm showing you is the level of real disposable personal income. This is basically the income in aggregate that individuals have to spend after they pay their taxes. And this is indexed to the beginning of the right before the pandemic in February of 2020. And the unusual aspect is because of the substantial government support has played out throughout the pandemic in the forms of emergency unemployment insurance, checks to individuals with incomes of less than 150,000, and other support mechanisms. Real disposable personal income actually rose sharply during the recession. That's unusual. That typically is not the case. If we looked historically, if we took this picture back and looked over the past recessions since World War II, what you would typically find is that real disposable personal income falls rather markedly for at least a few quarters before beginning to bounce back. This is unusual, and it I think plays into the sharp shifts in demand for consumption that we've seen. The ability for, in some sense, there are groups that benefited greatly from this and were offset largely from some of the impact the pandemic had on their ability to earn income. So I'm not making a value judgment one way or the other. The point I'm trying to make here is a lot of the spending that we've seen and a lot of these shifts in demand and the supply chain disruptions and difficulties I think that firms are dealing with at the moment has a lot to do with the ability to continue to consume. That during a normal recession or a typical recession wouldn't necessarily be the case. Okay. I want to shift gears a little bit. So I gave you a notion of kind of what the aggregate picture looks like, what the aggregate facts are, the fact that the COVID pandemic is challenging from an economist point of view because of the dramatic amount of dispersion and the way that individuals are experiencing the economy is so varied now. But also what I want to talk to you is next is about this notion of substantial further progress. Are we there yet? And this is from a monetary policy perspective. All right, so I told you I'd get to some cool charts. This is one of the coolest I think we produce at the Atlanta Fed. It's our labor market distribution spider chart. We call it a spider chart because this is kind of looks like a spider web. I think other folks might call this a radar chart, but I'm not going to quibble. It's closing in on Halloween. Spider chart is what I'm going to call this. Basically, this is a way to look at variety of metrics around the labor market performance, from employer behavior in the upper right-hand quadrant to employer confidence, utilization of labor in the lower left-hand quadrant, and then leading indicators of what's likely to happen going forward. And what this tells us is, and it can actually give us a broad picture of the overall health of the labor market. And it's a really useful summary tool. In the very center of this spider web is, that green ring. And you can see that's the minimum. That's the lowest levels that each one of these indicators, each one of these data series have seen post-World War II. And the outside, the maximum ring, the very outer edge of this spider web is the highest levels. So everything is sort of standardized or normalized for a specific indicator within those two rings. Basically, the center ring is the lowest, the outer ring is the maximum. So let's start with where we were prior to the pandemic. This is in February of 2020. And the green line that's going around this ring suggests a labor market that it's quite tight, fairly tight, as a matter of fact. The unemployment rate was at 3.5%. That's pretty close to being at the maximum. There were lots of firms indicating that they were unable to fill job openings, that labor was scarce. They still had very strong hiring plans, but they were having trouble really getting enough people in the door. And if we look at some of these other measures, the employment to population ratio was strong. The share of individuals working part-time for economic reasons was moved in a positive direction. So the more the lower that is, the more positive that indicator is telling us. The one thing that really we weren't seeing a whole lot of prior to the pandemic was a lot of wage growth. In fact, the employment cost index was kind of near the median, or a sort of typical labor market. And that's not necessarily reflective of the strength that we were seeing in some of these other indicators. And just an aside, I am not quite checking the Q&A and chat yet, but someone can feel free to interrupt me if there is a clarifying question or you wanted to dig into any one of these slides a little bit deeper. So again, going back to February of 2020, things were looking fantastic. Let's move forward and look at really what happened in the depths of the pandemic. That's going to be this green line now, the April 2020. And then let's look at what's happening now as of August 2021. So relative to February, in the beginning of the pandemic, now it's the blue line here. 2 short months later, and basically every one of these indicators was telling us this is the worst labor market we've seen in a long time. Everything except for the average hourly wages. The reason for that has a lot to do with the dispersion that I showed you across employment outcomes earlier. Basically, the lowest wage and the lowest skill workers were disproportionately impacted at the onset of the pandemic. So when you're taking an average, basically the lowest average hourly wage workers were not counted during the early part of the pandemic, as they were lost their jobs. So the average kind of went up a little bit. If we look at this orange ring, the solid, a thicker orange ring around the spider web, it tells us a story that basically employer behavior, employer confidence, when it comes to hiring plans, hire rates, job openings, vacancies, quits rates, they're telling us that the labor market is about at its tightest cyclical position that it's been in quite a long time, even tighter than what it was prior to the pandemic, and that we were dealing with a very, very tight labor market. The unemployment rate maybe not quite as low as what it was in the prior to the pandemic. Again, I think that has a lot to do with this notion of dispersion. And then you can see some other things that look a little odd. So it's not a perfect circle around the maximum, and that would make it the job of distinguishing whether or not the economy's made substantial further progress quite easy. If everything was basically telling us, the economy, the labor market was super, super tight, we could go home. The decision would be very easy to make. But a couple of areas that we're seeing sort of lagging behind some of the employer behaviors series is finding rates and some of the labor market labor force participation rates. And this is kind of an interesting question, because those dig at and try to get at sort of labor supply issues. So are individuals willing to engage in the labor market at the moment? And again, maybe this is an easier way to show, distill some of the information that was on that previous spider chart. Looking at hiring and job opening rates now, these orange bars are the most recent ones we have, and they're telling us that employer behavior and wage growth is very, very strong relative to other points in history. Looking at the start of the Great Recession, looking at the midst of the last recovery, and looking at right before the onset of the pandemic. Again, things across a broad scale are pointing us towards a tight labor market. Not everything in concert, but more indicators than not are telling us that things look pretty tight. Okay, and then that brings me to this aspect of the talk is should we think that we need to go back to the level of employment that we saw prior to the onset of the pandemic in order to say that the labor market is officially tight now? And my answer to that is I don't think so. And I don't think so for two reasons. Reason one is that we saw a dramatic increase in retirements as the pandemic, as folks started to figure out that COVID was going to last longer than a couple of months. I think, right at the beginning, there was a question of, whether or not, this was going to be a 2-3 week sort of thing. And I'm just getting a little vacation. I left my coffee mug on my desk and didn't really pack up all my computer peripheral equipment, things like that. But as the months increased from March until May and June, I think individuals started to figure out that this is going to be something that was going to be a bit longer lasting. And as older individuals were faced with some rather imperfect trade-offs, we saw a dramatic increase in retirements. And these retirements, I don't think are going to be short-lived. I think these are pretty permanent in the sense that these individuals are not likely to return to the labor force en masse like they did, say, during the Great Recession. So there's a significant portion of that 5.3 million that were short of the employment level in February 2020. A significant portion is the fact that there are fewer individuals in the labor force 55 years and over. I think it's close to about half of that, a shortfall. The other part, and this I hinted at earlier in the talk, with the disproportionate impact that the pandemic had on women's outcomes, labor market outcomes, employment outcomes. This information comes from a Policy Hub paper by my coworker and colleague, Melinda Pitts. It's called "Where Are They Now? Workers with Young Children During COVID-19." And honestly, this probably makes sense to a lot of individuals that are watching this that have had challenges finding childcare, challenges with dealing with or trying to manage the kids' schooling schedules when they're virtual, whether or not they're going to be fully in person on a sustainable basis going forward, who knows? I mean, these are actually things that we're picking up in the data. So individuals, women with children under the age of 6, who made up 10% of the pre-pandemic workforce, account for almost a quarter of the unanticipated employment loss related to COVID-19. So I think in terms of shares, we're closing in on something right around 2/3 to 3/4 of the employment shortfall that really we don't anticipate coming back quite these individuals re-entering the labor force swiftly. So these are things that are likely to persist for some time. Okay. I think the hot button topic at the moment is around the supply chain disruption and lack of labor availability and their impact on inflation. And I think a word that a lot of people are throwing around is the word transitory. Princess Bride's one of my favorite movies. I hope it's yours as well. But there's this great line as, Vincini is using the word inconceivable, and he keeps using it. And things happen that are inconceivable. And he goes, "You keep using that word. I don't think I don't think that word means what you think it means." And this is my point around the word transitory. The way that economists are using the word transitory, I think in general, has very little to do with the sort of time dimension that a phenomenon is going to last. It has a larger notion of the impact that the phenomenon is going to have on the medium-term outlook. So when economists are calling supply chain disruption and their impact on inflation transitory, or they're calling this reopening reflation that we saw across airfares and car rentals and used cars and in all these specific categories of the consumer market basket, economists tend to say, "Oh yeah, that's transitory." meaning that's not going to impact my long run outlook. That's something that's going to resolve itself without any sort of long run economic spillover. And I think in general, most people, when they hear the term transitory, especially if they're not used to the sort of a economist lexicon, if you will, I think when most people hear the word transitory, they ascribe a time dimension to it, something that's not going to last for a long time. It's something that's going to be fleeting. And here, I think the better word that we can start using around what's happening with supply chains, the lack of labor availability that a lot of firms have seen, and the nominal impacts or the price impacts and the cost impacts that we're seeing. I think the better word is probably episodic. It's something that when, if and when the pandemic situations around supply chain bottlenecks alleviate themselves, the price pressure that we're seeing in these sectors is going to abate. When we get back to a sort of a normal looking labor force participation rate or employment to population ratio, we'll see this lack of labor availability begin to abate, and the wage consequences from this abate. So I want to show you a couple of things, and these are going to be live here soon. So maybe we could have, I know we're recording this, but maybe some Chatham House rules around sharing this broadly. But these are some new results from our CFO survey. It's a survey we produce with the Duke University, the Federal Reserve Bank of Richmond, and the Federal Reserve Bank of Atlanta. And the notion here is that a large cross-section of firms are experiencing supply chain disruption across a variety of different metrics. What I'm not showing you is it's in materials, it's in delivery delays, and inventory stockouts. I mean, there's a significant disruption to supply chains. And the other thing that we're seeing is that for a large swath of these disruptions, firms do not expect them to abate in a swift manner for the most part. In fact, the modal firm across all of these anticipates the second half of next year is when the majority of these supply chain disruptions will begin to unwind and undo themselves, and things will get better. And for some firms, and non-trivial, 20% or so, they anticipate things returning to normal in 2023. So the notion that transitory means it's going to end quickly, I don't think that's necessarily true. And if that's the way that individuals are using the word transitory when they're describing its impact on inflation, I think we need to be careful about that. In fact, one of the things that we're seeing now in one of our other surveys, this is from the Business Inflation Expectation Survey, is that employers and firms are trying to find different ways to mitigate the supply chain disruptions that we're seeing when it comes to finding newer redundant suppliers or moving from a just-in-time to a just-in-case inventory scheme, changing products or product lines, sometimes canceling or not offering certain products or turning away business opportunities. We've heard stories and we see evidence here of firms diversifying shipping logistics. So and typically, if you're going to import intermediate or finished goods from Asia, doing so on a freighter or shipping in a shipping container is probably the cheapest way to go. There are firms that are struggling to do that and starting to look to airfare and other ways to get goods into the country. All of these sort of ways that firms are responding to the supply chain disruptions speak to two things. One, they speak to the sense that this is not something that is very fleeting or is something that firms can afford to sort of look past in the very near term. And two, most of these are costly ways to mitigate the supply chain disruptions. You would think that just-in-time inventory management scheme and with the lowest cost supplier for a lot of goods producers or intermediate goods suppliers is the right way to go. Finding newer redundant suppliers, and the way why you wouldn't have done that in the past is because they were more costly. So all of these things are likely to add to firms' costs in going forward. And they speak to something being a bit more a permanent, structural, or durable, whatever word you want to use that would describe what we're likely to see is a shift in the way that businesses approach their supply chains. And as Delta has emerged, most of the concern, or the lion's share of the concern, has been centered around, okay, how will Delta impact this Delta variant or other variants impact supply chain disruption going forward, stuff that I've already seen to be rather significant. And here's the crux of the situation when it comes to the supply chain stuff, and maybe why I think there's potential upside risk to the inflation outlook, and why there's at least cause for some concern and monitoring is, in the short run, what I'm showing you on the left-hand side of this picture is firms' expected change in unit costs over the next 12 months. This tends to be a good measure of what we would call a proxy for inflation expectations from businesses, because we think that firms pay a lot of attention to their costs, much more so than they pay attention to sort of aggregate CPI or PCE price indices. And we can trace a lot of this upward pressure that we've seen since about August of last year in expected unit cost change. We can trace that to supply chain disruption among these firms. So 52% of the firms in the BIE panel are experiencing moderate to severe supply chain disruption as of August. They're also experiencing delays in delivery and shipping. 41% of these firms are also experiencing moderate to severe shortages in the supply of labor. That's up from 21% in March. And again, this is putting upward pressure on individuals' cost expectations going forward. Where this becomes, where this becomes a concern is if this starts to feed into the way that firms are anticipating the cost environment to be over a long, long period of time. So a 5 to 10 year period. If they start to think, hey, this is going to be this is going to be what normal looks like, 5 years from now. I'm going to be still dealing with some very high costs of production, much higher than what I was dealing with pre-pandemic. And as a result, I'm going to begin to raise my prices much more frequently, or when I do in larger percent changes. And this will actually feed through into higher experienced inflation in the economy. And this is what, when economists are talking about inflation expectations and whether or not they're well anchored, this is the concern that they have. And one of the issues that perhaps I'm concerned about, or maybe even most concerned about, is whether or not individuals will continue to see supply chain disruption and lack of labor availability play out over a longer period of time than what officials have called transitory, and that actually changing their perception or their behavior when they think about longer run price and cost structures. And that would just, again, that would feed through into much higher inflation than we've seen so far. So I want to make a couple of points about current inflation, and then I'll wrap up and take your questions. One of the things we can do to see if the price impacts on the consumer market basket that we're seeing is all due to the supply chain disruptions or not, is look at a couple of broad-based measures of inflation. One that gets mentioned perhaps most often in the press is the core CPI that I mentioned earlier. And yes, the core CPI in the most recent, in August, slowed. So it increased at an annualized rate of just 1.2% for the month. It's still up 5%, 4.5% on a year-over-year basis. But 4% on a year-over-year basis. But it slowed in the most recent month, and it slowed in large part because Used car prices fell, airfares fell, and lodging away from home, those prices of hotels, motels, and accommodations, they fell. And the reason that they fell, I don't think is I think it's pretty clear as the number of COVID cases increased around the Delta variant. The prospect of going out and socializing, I think for some individuals became a bit dicier. So that's what's going on there, and this is just some additional fodder for that. But the point is, we need to look past these sort of episodic price changes and looking to see what's happening in the center of the price change distribution, or looking at really what's happening in the center of inflation, these sort of measures of broad-based price pressure. And two of them come out of the Cleveland Fed. They're in the blue, it's the median CPI. So you, on any given month, you organize the price changes and sort them from lowest to highest across the market basket. You hit the one in the middle, that's the median. The trim just ignores very large price swings on either side. So the 16% trim mean just takes 8% of the changes in the market, price changes in the market basket, and just cuts them out and just takes an average of what's left over. And you can see over the last 3 months that these measures are increasing rapidly. We're seeing a sharp acceleration. This speaks to the growing sense of the broad-based price pressure moving beyond some of these supply chain impacts on prices, and moving beyond some of the the reopening sort of price effects that we saw over the summer months. And in fact, here's another way to see this sort of broad-based pressure is looking just at the fraction of the CPI increasing at rates greater than 3%. About 3/4 of the consumer market basket in August increased at 3% or greater. Again, it's looking a lot more broad-based. And then, so when these episodic prices abate, whenever that may be, maybe it's not until the end of 2020, maybe it's in 2023, we'll have a couple of more durable relative price changes to worry about. One of them is in rents, and this is the way that house prices sort of feed through into the market basket. We're seeing evidence that those are increasing now and will likely increase at stronger rates in the future, something maybe north of 4%. And then we're also starting to see pressure in areas that are tied to areas of the consumer market basket that are tied to wages. This is a growth rate in basically service dining prices, so full service meals and snacks. So basically going out to eat. The CPI for this category is up over 8%, 8.5% over the last 3 months. Delta hasn't put a stop on this. This is really tied in large part to wages, and we anticipate that's going to continue. And again, if it starts to feed into wages, then we have things that look a little bit more durable and are much more likely to impact the the inflation environment over longer periods of time. All right, I think I'm a little bit out of time, but the note I want to close with this. We talk about, the FOMC has talked about these longer run averages, or trying to average 2% over a longer period of time in order to anchor inflation expectations at a policy consistent level. So, something that would tell us we're likely to get 2% inflation in the future. So when you have a low inflation over a period, you want higher inflation now to average things out. Well, here I want to make a point, and this is an alternative way to look at something that's on our Atlanta Fed website, the underlying inflation dashboard. So it takes a lot of different measures of price pressure from both the CPI and the PCE, and then looks at what they're telling us relative to sort of price stability. And if you're in the green, you're pretty much price stability. If you're a little bit below target, you're blue. If you're way below target, you're purple. If you're a little bit above target, you're orange, and then red is screaming hot, right? So let's look at, a long time window, an average for inflation or for underlying inflation of, say, 8 years. Well, as of last month or August 2021, a lot of these measures were signaling that, over a long period of time, we're pretty close to 2%. And in fact, if you look at the core PCE, which is directly in the middle row of this table, over the last 8 years, once we factor in what's happened during the pandemic, that 8-year window, we're at 1.9% on core PCE. So we're almost to 2. And as you move in, take a 4-year window. If we were thinking about a flexible average inflation target, it'd probably be somewhere between the 8-year and 4-year window. If we're looking at a 4-year window, we're certainly by most measures at a signal of price stability. If you'd split the difference, we're basically there. And as you move forward, things start screaming hot. And over the last 6 months, every one of these indicators of underlying inflation are telling us that inflation in general is running at a higher rate than what would be consistent with price stability. So what we're seeing is a broadening of price pressure, an acceleration of this price pressure throughout the basket. And these are things in combination with some of the movements we've seen in inflation expectation that perhaps maybe give me some pause in how we're thinking, or at least how we ought to be thinking about monetary policy going forward. And again, that's my opinion. And what's at stake here is the unanchoring of inflation expectations to the upside. So I think what I'd like to do is say thank you, stop there, and then answer some questions.
Brent, thanks very much. Just as a reminder to all of our participants today, click on that Q&A button if you do want to ask a question. We already have a handful already there for you. I'm going to work my way backwards, and I'm just going to read them verbatim. So curious how you square the data which shows the price pressure you're describing and the market in the 10-year treasury yields and others, which even notwithstanding recent upward moves, shows a very low level of inflation expectation. This in the most liquid and examined market on earth. I can't get my head around it. Curious on what you think.
Yeah, that's a fantastic question. In large part, I scratch my head over what's happening there too. I think if you look at the 5-year forward inflation compensation measure that comes out of the difference between tips and treasuries, that's at about 2.2%. It's not overly low, but it sure isn't high by any stretch of the imagination. But what's happening in those measures isn't a pure inflation expectation. There are other things that happen in those inflation compensation measures that may obscure the actual any changes in inflation expectations that we might witness in those markets. Some of this has to do with liquidity and risk premia, and some of this could potentially be impacted by a lot of what's happening in the treasury market. So those measures, yeah, I agree. It's curious. But I tend to lean towards the sort of survey approaches, even though everything's imperfect. It's just harder for me to kind of wrap my head around all the other things that are impacting the inflation compensation measure that makes it harder to tease out an inflation expectation from those markets. So that's a fantastic question, though. Thank you.
Thanks, Brent. Another question, and inflation related, shocker here. So you're using some real stats in the presentation, such as real GDP. How quickly do inflation measures react to changes in the basket of goods? I'm thinking of CPI, given how travel, entertainment, et cetera, shifted during the pandemic. Again,
a fantastic question. The CPI is a fixed basket of goods, and it's fixed for a period of about 2 years. They update it every year for changes in prices for each one of those components, but only every 2 years for changes in consumer behavior. And they use the expenditure survey in order to make those changes. So what we're seeing in the CPI basket is not reflective of the dramatic shifts in consumer spending behavior that we've seen during the pandemic. So to your point, one way to, and one reason I think why the Fed prefers the lesser known personal consumption expenditures chain price index is because changes in consumer spending behavior and sort of nominal shares of spending are incorporated instantaneously, basically as of that month in that measure. So by taking a broad look at the underlying inflation like a dashboard approach, like I showed you at the end, we're getting something that we think appropriately looks at those shift changes in spending. So again, that's another great question. Thank you.
Awesome. And to wrap it out, a non-inflation question, actually question about, could you discuss a little bit on the GDP Now forecasts, kind of what goes into it? And I'm going to tweak this question a little bit. Can you also reflect on kind of the performance during COVID in response and in light of COVID, and any anticipated changes on the horizon?
Sure. No, this is a great question. A colleague of mine, Pat Higgins, put this measure together, and he put it together in a way that it would attempt to approximate what the individuals at the census are doing when they fold in new data releases. And it's a ground up approach to attempting to measure GDP in the same way that the census does. So it's different than some of these other sort of, sorry for the verbiage, the dynamic factor models or models that try to tease out signal from a variety of indicators. It's really trying to measure the influence every single data release has on the measurement of GDP growth, and then uses a modeling approach to stand in for the data it doesn't have in the quarter. And you're right to point out that the performance of this measure hasn't been, stellar. I mean, it was certainly stellar prior to the pandemic. It was even without imposing judgment. So it doesn't really, even if we know there's going to be, even if we have a very strong view of what's likely to happen in the data, we don't allow that judgment to impact the forecasts that are coming out of GDP Now. And that's in large part, that's why its performance during the pandemic has been not so great. So you can look, especially around the government transfers. So we're not feeding in any sort of outside information on government transfers that would impact disposable income and consumption into that model. We're just basically trying to pull the most recent data release and use statistical methods to forecast stand-ins during the month. So that's in large part what's happening there. And the useful, and by the way, the usefulness of GDP Now is largely around its ability to not impose judgment, and gives you a juxtaposition for a lot of what private forecasters are forecasting. So you can get a sense of potentially how much judgment or uncertainty there is about the current quarter readings. So again, these are fantastic questions, a great audience. Thank you.
Well, that has addressed our queue. I'm going to hand it over to Mark to close out the program.
Thanks, Chris. That was a great presentation and very insightful. Thank you, Brent. And thanks to everyone who connected with us today. Please look for an event survey to follow, including the replay and meeting presentation. And that concludes today's presentation.
All right. Thanks, everyone.
Thank you, Brent.